Okay, welcome to our special webinar looking at aspects of market failure and government intervention. If you want to access any market failure resources on the website, just point your smartphone camera at the QR code and that should take you to our landing page where there's lots of different resources available for you to use. What examiners tend to do is they like to choose sectors of the economy where there might be one or more market failures at work and where they can really get you to test your understanding and build some good analysis first of all and then evaluation. So market failures might range across the labour market, financial sectors, obviously environmental issues, very much prominent at the moment, market imperfections in monopolistic and oligopolistic markets, the housing sector, and of course the externalities arising from commodity extraction. So there are many different industries where market failures occur, and the key is to be able to analyse and evaluate them well. Here's a slide showing some of the key concepts that you need to be really clear on, exceptionally clear, before you take the exam. Standard theory assumes that rational agents, producers and consumers, are acting in their own self-interested way to try to maximise their utility, their consumer surplus, their profit, their producer surplus. People only considering their own narrow private benefits and costs. We know that, of course, that's not the case, but standard theory assumes oftentimes it is. And lots of market failures can result from that. Of course, market failure allows you to bring in the social aspect of economics, social welfare concepts, including social benefit and social cost. Try to be really clear going to the exam on the different types of economic efficiency, allocative, productive and dynamic. And also be aware that inequality of income and wealth and consumption, any inequitable outcome that arises from consumption and production is regarded by many economists, not all, but many, as a form of market failure. Lots of many different market failures, of course. Information failures lie at the heart of many issues, including asymmetric information. Increasing interest in the nature of private versus public goods, the free rider problem, how best to protect our common pool resources, and lots of issues, of course, to do with market power, imperfections in competition in markets, and barriers to entry. So what I'm saying here is that market failure and market structures are very closely linked. They're going to form the core of most micro-exam papers at A-level. One distinction to make, or to be at least to be aware of, is the distinction between complete and partial market failure. So we're going to focus tonight on partial market failures, but a complete failure will be a missing market, where the market mechanism left to its own devices fails to provide a good or a service. And we most usually associate that with pure public goods. Partial market failure is where there's an inefficient outcome or an inequitable outcome from a social point of view. An obvious example of that would be negative externalities from production and also from consumption. So in terms of missing markets, the economics of pure public goods remains highly interesting and highly relevant. So the extent to which, for example, the government should be a funder and provider of core, if you like, public good infrastructure, be it sanitation facilities, flood defence for our towns and cities, the extent to which policing has a public good aspect, the economics of providing vaccinations for people free at the point of need, the economics of widely available public knowledge, online learning, and public service broadcasting. I'm not going to go through public goods in much detail tonight. I'm sure you've revised it heavily, but you need to make a distinction between public and private goods, and also public versus quasi-public goods, and the whole debate about who is best placed to provide certain goods and services, how best to overcome the free rider problem, and crucially, the whole issue of efficiency and equity in making these public goods available to people. Affordability and access are key. Externalities nearly always figures very prominently in any exam on market failure. So please go into the 2018 exams really well genned up on externalities. We'll go through the 4 main externality types now. Keep in mind that not every exam board requires you to know the 4 key diagrams, so we'll try to remind ourselves of those as we go through it. Well, first of all, you have negative externalities from production. Classic externalities include the external cost from fertilizers used in farming, the external cost of noise pollution in the airline industry, industrial waste products, be it air and noise pollution from factories, and other factors. Key diagram here, of course, is that with a negative production externality, the marginal social cost lies above the marginal private cost. I've drawn the line here as diverging, and if MSC pivots away from MPC, then we say the marginal external cost of the increase in output is increasing. The marginal external cost is the vertical distance between MSC and MPC. Little exam tip there in the top left-hand corner. Exam diagram should be ACE. Axes, curves, equilibriums. Please remember to draw to the axes, to label them, and to show the equilibrium points. In this case, the private equilibrium is Q1, free market equilibrium. That is market failure. It's allocatively inefficient because we're overproducing products which create negative externalities from production. And I'm sure you could then develop the diagram to show the deadweight social welfare loss. Negative externalities from consumption include, not exclusively, but include things like the externalities from driving cars, from gambling addiction, from people dropping litter, from noise and air pollution from consumption, and of course the increasing external costs from obesity. So with negative externalities from consumption, the AQA diagram is that the marginal social benefit lies below the marginal private benefit. With a negative consumption externality, the consumption of a product lowers the benefit enjoyed by a third party, so therefore the social benefit is less than the private benefit. The result is overconsumption, overproduction as well as a market failure here, and again you can show the deadweight loss. Little exam tip, bottom left hand corner there, not just ACE but ABCs, accurate, big and clear diagrams please. Ideally half a side of A4 for your diagrams. Really make them clear and focused for the examiners. Positive externalities, of course, external benefit, in this case from consumption. We tend to associate these with merit goods, consumption of libraries and museums and galleries and early years education. And with a positive externality from consumption, the marginal social benefit lies above the marginal private benefit. As a result of the market failure here, there's a lack of consumption. The social optimum position is Q2, whereas the private optimum is Q1, and there's a green area there showing the social welfare loss. If the market price ignores the externalities here, the market will tend to underconsume consumption products which have positive externalities. And AQA also require you to know about positive externalities from production. This is where one firm's production activity reduces costs for somebody else. 2 really good examples: the open source software movement, which makes its code available for developers at will, and the spillover effects of positive externalities from research and development. In the case of positive externalities from production, the marginal social cost, MSC, lies below the marginal private cost. Again, there's under production here. Because of a positive externalities, the marginal social cost is less than MPC. Therefore, positive production externalities shift the supply curve to the right, and we tend to underproduce or underprovide things where there are positive externalities. The top level analysis oftentimes thinks that there are both positive and negative externalities. So in this situation, I've drawn a position where there are net social costs. In other words, there's quite significant negative production externalities. Can you see the MSE curve way above MPC? But I'm also assuming there are some social benefits, some external benefits. So MSP lies above MPB. As a result, the private optimum is output A, where you just consider the private costs and benefits. The social optimum is at B to the left of A because the external costs are bigger than the external benefits. So we'd probably want the social optimum to be lower at Q2. However, it could be the case that you have a net social benefit. In this case, there are some big positive externalities and some relatively small negative production externalities. So the social optimum lies at B. The private optimum lies at A. We're under-consuming, under-providing the product. Again, a source of market failure. In most exam questions, you're either given a clear steer to talk about a particular type of externality, or you can build into your diagrams, build into your analysis and then your evaluation, the idea that there could be both negative and positive externalities. And then it becomes a question of which you think is greater. So your diagram will then reflect the judgment you make in your essay. And again, make these diagrams big and clear with a nice bit of explanation underneath so you get top marks for analysis. Merit goods, of course, associated with negative, positive externalities from consumption. So merit goods give rise to external benefits. There is a value judgment involved here, but if there are external benefits, we tend to under-consume merit goods from a social point of view, and hence there's a case for some form of intervention in the market to address this. Demerit goods, obviously the opposite. So topical examples at the moment include addiction to gambling, addiction to violent games and films, smoking of tobacco, consumption of high fat, high salt, high sugar products, student dependence on caffeine energy drinks ahead of exams, all kinds of issues where with value judgments embedded into these arguments, society would probably want less of these things to be consumed. And you can't be divorced in talking about demerit goods from the information gap or the information failure that could be at work here. So with demerit goods, oftentimes people don't have full information about their own costs and benefits. For example, if they had better information that the benefit was less than they thought, the demand curve would be to the left. If they had better information about their own private costs, the marginal private cost curve would be higher, both of which would shift the quantity to the left. Another nice bit of exam advice here on the left-hand side. If in the exam you just draw a diagram from memory, it's probably only going to get you A or 1 marks. The skill in the exam is to be able just to adapt, improve, change your diagram to reflect to the stimulus that you have. So with most examiners are looking for a developed diagram rather than just the diagram per se. They want to see something happening, a shift in a curve, a particular area that you want to focus on. That's what makes the diagram important to you from a KA point of view. Loads of examples of information failures, of course, in markets. Asymmetric information is something students revise heavily. Whatever it is, painkiller addiction, complexity of pensions, information failures in the second-hand market for products, information gaps in terms of nutritional content of food. Loads of examples of where information gaps can lead to a distortion of market choice. Well, we can't cover every market failure in this session, but we've just been through externalities and a bit of information economics. Let's just spend a few minutes thinking about interventions in markets. I'll start with a clear point, I think. If there is a market failure, there is a case for intervention in the market. The question then becomes, which intervention do you think is most effective or equitable or both? And do you need more than one intervention to solve a particular problem? I think the reality is that most economic problems are complex, they're messy, and they are multi-causal. So if a problem is multi-causal, you're probably going to need at least 2, possibly more interventions in the market. And then saying that then allows you to talk about which intervention might be more effective in the short term, which interventions might be most effective in the long term. Loads of topical examples at the moment. The Scottish government's just introduced minimum alcohol pricing. A couple of years ago, the Competition and Markets Authorities capped payday lending rates. Of course, this year we've had the introduction of the UK sugar levy for high sugar drinks. The government's just recommended they're going to cap the maximum single bet on a fixed odd betting terminal to £2 per bet. This year, the government's brought in the apprenticeship levy to try and increase spending on training. Big campaigns for banning plastic straws and stirrers and plastic cutlery. Of course, the whole debate about Volkswagen in terms of strict emissions for CO2 for vehicles. And just in recent years, the government's had a minimum price for carbon emissions inside the emissions trading scheme. So there are just simply loads of examples of intervention in markets that you can get your teeth stuck into in an exam. I just want to focus for a little bit about regulation. Most students go into exams pretty well prepared on things like maximum prices, minimum prices, indirect taxes and subsidies. Evidence from exam board reports is that regulation is not quite well understood, but it's actually quite important. So a regulation or law is a non-market-based approach to addressing one or more market failures. And there have been lots of examples in the UK in recent times: the ban on smoking in public places, the minimum age of 18 if you want to use a tanning salon, quotas to how much fish you can take, the proposed ban on diesel cars, which is a few years away now, directives on how energy efficient things need to be and how you dispose of things like washing machines and other household appliances. So lots of regulations, of course, many of which come from the EU. The key point, I think, is to be able to analyse why regulations might work and why regulations might not necessarily be effective. So essentially, if you regulate an activity, let's take, for example, consumption or production, which generates a negative externality. One of the main advantages of regulation is it's actually a spur for businesses to innovate. If you take, for example, let's go back a slide, if you take the maximum CO2 emissions for vehicles per kilometre travelled, top right hand side there, that cap comes down every year. All vehicles produced and sold in the EU must meet that cap. So it's quite a big incentive for car producers who want to sell vehicles in the EU to make their engines more fuel efficient, make their vehicles lighter, to bring down CO2 emissions. It seems to have really worked over the last 10-15 years. Another case for regulation is if demand turns out to be unresponsive to a price change. So, for example, again, going back a slide, if we bring in, two more slides, if we bring in, for example, the sugar levy this year, it may well be the case that demand for high sugar drinks, such as Coca-Cola and Pepsi, does fall. But it could turn out to be the case that the price elasticity of demand for those drinks is fairly low. In which case, if a tax doesn't work or a minimum price doesn't work, you might argue that regulation could be more effective. Putting a legal limit on consumption or legal limit on sugar content, for example. The other issue is that you can gradually toughen the regulations every year. So that regulation on emissions from vehicles gets tougher and tougher every year. Businesses know that, and therefore they can bring their investment forward to meet those regulations. Because if they don't, they could be fined, or rival firms could take market share from them. There are clear incentives to do that. So regulation can be effective. Equally, there are some disadvantages. The cost of enforcement can be quite severe. The penalties for regulatory breaches might be weak. Think, for example, about competition policy. Regulations, of course, can always lead to unintended consequences. There can be some feedback effects which weren't anticipated. And regulations often fall most heavily on small businesses. Oftentimes they're least able to cope with health and safety or environmental laws. And if they leave the market, actually the markets become less competitive, and that can damage consumer welfare. Any question on intervention by government always invites some discussion of government failure. I'm not going to go through all of these in detail with you. There is a separate video on government failure it's worth checking out with lots of good examples. But intervention in markets isn't always effective. There's always at least the potential for government failure, and this is worth bringing into your discussion to get strong marks for evaluation. So governments can make decisions based on political self-interest. They might be captured by lobbyists, influential lobbyists, who tilt policy in a particular direction. Governments might be searching for a political quick fix instead of thinking about longer term solutions. Governments may not have tested their policies properly. They may be suffering from information failures themselves. There can be some big enforcement and compliance costs. Their interventions might cause some disincentive effects in the labour market, for example, the poverty trap. And it could well be the case that actually environmental interventions, like a carbon price, have a conflict with other policies, economic growth, competitiveness and trade, for example. And we've already mentioned that regulations involve more legislation, more red tape, and that can sometimes hamper and hamstring businesses who are trying to be competitive in overseas markets. When you're evaluating government intervention, here are some questions to think about, which will then invite strong evaluation. First of all, how significant is the market failure? So, for example, litter has for many years been regarded as a fairly trivial market failure. Fly tipping of waste, chewing gum on the streets, and so on. Of course, in this year, we have become so much more aware of the global consequences of plastic pollution. Consequences not just for local communities, not just for the fishing industry, but for everybody's health. So it's clear that plastic pollution has become what is widely regarded now as a significant global, if you like, a public bad. There's multiple market failures here, and therefore perhaps significant intervention is needed. If the market failure is fairly trivial, well, maybe you don't necessarily need such a tough policy response. Secondly, can the market find solutions? You don't necessarily always have to intervene. Many markets respond to problems. Necessity is the mother of invention. So businesses are responding to the concerns about obesity. Businesses are responding to concerns about plastic pollution and climate change. Oftentimes the market, through the price mechanism, can respond to some quite compelling public policy issues. Intervention on its own may not be enough. The market can help. Think also about the consequences of not intervening. This is quite a subtle evaluation point, but if the government chooses not to intervene, perhaps the long-term consequences could be even higher, even more significant than we thought. Government is putting proposals out. It wants to ban diesel vehicles by 2040. Well, that's over 20 years away. Is that just too far in the future? Maybe they should have brought it forward 10 years or forward 15 years. Pushing stuff into the long grass is the equivalent of not intervening in markets. Always, if you have the chance, please, in an exam, question how effective is an intervention. What are the elasticities of demand involved? If you think an intervention is likely to be ineffective, straight away that opens the door to talking about alternatives. That's good evaluation. And good evaluation comes from talking about winners and losers. Who are the gainers from an intervention? Who loses out? And how might they possibly be compensated? So think about the equitable issues involved in interventions. Always consider potential for one or more government failures. Which works best? Do you think that the market-based mechanisms, such as a carbon tax or carbon trading, do you think they work better than laws on CO2 emissions? So come to a view on that. And many of you I know will have been revising behavioural economics. Whenever you get a question on market failure, there is always the opportunity to bring into play one or more kind of behavioural interventions, so-called nudge theory, using choice architecture and anchoring and priming and commitment devices, perhaps to change the behaviour of both consumers and also producers. So there we go. This has been a pretty whistle-stop tour through the economics of market failure and intervention. I hope it was useful, and thanks for joining in.